In this video, we're going to briefly introduce the concept of order flow trading. This is a totally different way of trying to make money from the market and to a large extent doesn't require price chart analysis at all. That's because traders who follow the flow of orders in the market use a totally different tool for figuring out how and when to buy and sell.
And that tool is this. This is a depth of market trading ladder. Very, very different from working off a price chart. Think of it a little bit like looking at the market through a magnifying glass. We're looking at every tiny movement of the price action moment to moment. And we can also use it to see all of the orders, all of the people that are buying and all of the people that are selling. This is the typical image that we normally associate with this type of trading. Someone's probably at the professional end sat in front of a whole load of trading screens with huge amounts of data in front of them. There's some charts there as well, but it tends to be predominantly lots of different markets with where we're looking at different ladders, the price is moving up and down. And what they're doing is they're watching it, looking for tiny discrepancies, tiny opportunities, which they can potentially then exploit to make a quick profit. So it tends to be what you might describe as a scalper's paradise, because you're in and out of the market generally very, very quick, multiple times over a trading session. So let's have a look at the actual breakdown of the order ladder itself. It seems like it is quite complicated, but in actual fact, once you get used to it, it's pretty simple. We have all of the people looking to buy in this left-hand column here that you can see. Those are all of the orders. In the middle, we have the actual market that we are observing, the actual current, the best bid and the best offer price. And obviously that moves up and down as the price moves. And then on the third column in, we have all of the people who want to sell that particular market. Those are all of the orders on the offer there that you can see. Moving along, this is more of a recent feature in ladder trading, and that is the volume profile as well. So that is the amount of trading that's going on throughout this trading session, and that builds up slowly over time, and that can build us a volume profile. And then finally, on the right-hand side, we have what is described as the modern-day equivalent of the ticker tape. This is basically the list of all of the transactions that go through the market at any one point in time. That is what we describe as our time and sales window. So it's actually very simple, but when you look at it in the real market, you'll start to see how challenging this type of trading can be. This is the real market in front of us, and I've got three markets here laid out left to right. I've got the S&P 500 here on the left-hand side. I've got in the middle, I've got the NASDAQ. And then on the far right, I've got the crude oil market. These are all futures markets. And we've got the June contract for the S&P and the June contract for the NASDAQ. And then we've got the May contract for the crude oil futures. You can already see how interesting and also challenging this type of trading can be because it moves so fast. We're in the middle of the US session now, and you can see the difference between the two equity markets as well. The S&P 500 is what we would describe as a much thicker market. There's more orders on the ladder. It's not quite as quick in the way that it moves. It's not quite as twitchy. Compare that to the NASDAQ. When we talk about markets being thin, you can see visually what that means. The NASDAQ is a particularly thin market, and it moves incredibly quickly. That is an inherent characteristic of how the NASDAQ works. Now, if you're an order flow trader, what you're doing is you're looking at these markets move up and down, and you're paying a lot of great attention to specific price areas that you're interested in, and you're looking to see orders come in and out of the market. You're basically looking for other buyers and sellers, and then trying to make judgments based on that, and then get in the market with a real statistical edge, and then make a very quick profit. On the crude oil market over here on the right hand side, that too is a thin market as well, but it does not quite as fast to move at the moment as the NASDAQ. So if you observe the time and sales windows as well, you can see all of the transactions go through on the market. So if you're doing this type of trading, one thing you have to do is you're probably going to be a short-term trader, but what's more important is your ability to focus and concentrate. you can't take your eyes away from the screen for a moment. You've got to really know what your game plan is for the session. You've got to really understand how you're with the types of patterns that you're going to be looking to actually trade, and then execute them with precision. So the types of people that like this way of working tend to be very pattern orientated. They tend to like practicing trading drills over and over and over again, because you get the same sequences of opportunities that get created in these markets, and they're looking to get very skilled at those and then get in and out incredibly quickly. So it's a very different way of trading than just trading on price charts alone. Now, if this is a type of trading that you think might actually interest you, if you ever use an MT4 platform, there is also a trading ladder within the MT4 platform as well. So if you fancy dipping your toe in the water with just sort of having a go at seeing what it's like to be trading off a ladder rather than entering orders onto a chart, head over to our partner broker Switch Markets and download a demo platform of the MT4 platform that we've got. There's a link in the description section below that you can do that. And if you press Alt B, it will bring up the standard MT4 order ladder, and that will give you a slight flavor of what it is like to actually use a trading ladder as a part of your own trading process. You can run it alongside the charts as well, but it's a great way to just dip your toe in the water and give it a try if you've never done it before. Now, within the whole subject of trading off a ladder, there are a lot of different ways that people look to exploit the opportunities that are available, that are presented. There are also some things that you are not allowed to do. And there's a particular technique which is illegal, and that is called spoofing. It is a form of market manipulation, and it is something that the exchanges take incredibly seriously. I'm just going to talk you through what spoofing is and how that works. So you can see that we've got an order ladder here which is not moving, so this allows us to illustrate the whole concept perfectly when it's nice and still. If someone is spoofing the market, they are basically making a bid or an offer on either side of the market for that security or that market or that commodity, with the intent of cancelling that order before it is executed. So what does that actually mean? It means that the trader is being manipulative. They are being disingenuous, and they're not actually showing their hand in the traditional sense. And the way that basically works, if you imagine that we've got this S&P 500 market here, and we've obviously got the current bid and offer is 4,143 and a quarter against 4,143 and a half on the offer. If you are a spoofer, let's say, for example, you're someone who's got a reasonable amount to buy, a big block of contracts to get into the market, and you're looking to get them in at around about this area here, so about the 42s, 42 and a quarter, 42.50, something like that. But as you can see, the market is not trading in that direction yet, and you want to get all of that, your buy orders in there. What a spoofer would do is they would passively park their orders here in just underneath the current bid, and what they would do is over on the offer side here, they will put a huge order in that area. Something like, you can see here we've got 53 contracts, 69, 67. They'll put something outsized, I don't know, maybe sort of 200, 300, something like that, a really big order. And what that does is that signals to everybody else that's looking at the market that there's a big seller in the market. And that means potentially the market is going to go down as a result of that. So what can happen then is other people that are trading can look at that and say, okay, well, if the market's going to go down, what I'll do is I'll get my shorts in quickly just before that big order, say, for example, the order's at 44, and then what will happen from there is they will front run that big position. And as they start to get their positions in and the market starts to auction down, more people join in that process. And that is how we get this sort of mini feedback loop of the market starting to fall. Meanwhile, our spoofer is now starting to get filled on the prices that he originally intended to in the first place. And then as soon as he's all of his buy orders have been filled, what he does is he cancels that huge great big order that he put up there, which means the market has been artificially pushed in one direction. There's a lot of other traders now that are now in the wrong direction because they're short in this area, and that big seller has just disappeared. And then as a result of that, the market then pings back in the other direction really, really quickly, catching everybody else off guard. In the meantime, our spoofer got all of the long contracts that he wanted in the market, and now he's able to now offload those at a higher price and make a very easy profit. He's basically manipulating the market. That as a process is there's different ways that it works, but that is the basic process of how spoofing the market actually works, and it is illegal. So if you ever do become an order flow trader and you're able to get to a certain level where you can put a certain amount of size into the market, you have to be very careful about how you actually go executing your orders. The key with spoofing is that it's all about intent, whether you intended to cancel that order before it got executed, but it is illegal, so it's definitely a no-no.
So as you can see, the whole subject of order flow trading is a completely different way of looking at the market. It's much more granular, and you have to be very fast, accurate, and totally focused on the ladders to capitalize on the opportunities that the market offers you. It's a specialized field of study, and when you're trading with leverage, it is not for the faint-hearted. But despite the computer algos ruling the short timeframes, the human decisions that move the price don't change at all, meaning the patterns that we see in the trading ladders recur over and over and over again. Don't forget to like, comment, and subscribe, and we'll see you in the next one.